So you just sold your business for $10 million, but now you have a new problem. What should you do with your money? How much should you spend versus invest? Where should you invest it? How do you structure things so that you don't become one of those people that lose it after a few years? And ultimately, how do you set yourself up for a life of freedom and not just bigger responsibilities and higher taxes? So in this video, we'll answer that question. And before we dive right in, I should introduce who I am. My name is Daniel O'Loughlin, and I've over a decade of experience in the investment world. I've worked as an analyst at S&P Global. I have a master's in finance. I'm also a chartered alternative investment analyst, and I've published papers on predicting asset prices that made a significant impact in the field of investing and behavioral finance. But most importantly, I spent the last 10 years studying markets and developing the tools to consistently outperform them, which ultimately allowed me to quit my job and manage my personal wealth full-time 4 years ago. So in this video, I'm going to walk you through how I would approach managing a net worth of $10 million, how to allocate it, how to legally minimize your tax bill, and how to design a life that's rich in more than just financial value. So, you didn't get to $10 million by just being average, so we're not going to settle for just average investing. At this level, capital preservation is just as important, if not more, than growth. The key is smart asset allocation and solid risk management. Remember, the goal is to make your money work for you without taking crazy risks that could wipe you out. That's what we're focusing on. High net worth individuals typically diversify their money across stocks, bonds, real estate, and alternatives. That means that no single investment should dominate your entire 10 million stake. Diversification, when done strategically, is your insurance against the unknown. First, we're going to create a wealth preservation bucket, which should make up about 45% of your total net worth. And we're going to split this between equities and bonds. So within the wealth preservation bucket, 2/3 should go towards equities. Now you want to broadly invest in several different areas. So this is going to mean investing in some index funds, blue chip stocks, and also dividend stocks, especially because these will provide you with dividend income. Now, typically you can expect 0.25% to 3% in dividend income from many of these companies, and you can find higher dividend paying companies, but sometimes you won't see capital appreciation, and therefore you're taking on the income of a bond, but taking on the risk of a stock, which often isn't worth it. Then the final 1/3 of this wealth preservation bucket is bonds, specifically investment grade bonds, which provide stability and income. Overall, your bond portfolio will help preserve capital and cash flow for when markets get volatile. Now, we're going to talk about alternative investments. At a $10 million net worth, you get access to the deals that regular investors can't. Think private equity, hedge funds, and venture capital funds. Many of the ultra high net worth people with a net worth above $30 million typically allocate significant chunks to alternatives, often 25% or more, and that's specifically because they can offer higher returns and better diversification. However, if done correctly, you can create investment returns that are relatively uncorrelated to the general market, thus further preserving your wealth. Here's the thing though, only invest what you're willing to lock up for maybe 5 to 10 years, and do your due diligence. Alternatives can be quite illiquid, meaning you can't get access to your cash or sell your investment at a moment's notice. So overall, I would recommend for your alternatives bucket to invest approximately 20% of your net worth. Now, real estate. Real estate is a preferred asset class among millionaires. You can buy rental properties, real estate investment trusts, and private real estate funds. You have many options and of varying levels of effort that you need to put in to build this part of your portfolio. Real estate is great because it can provide steady cash flow and it appreciates over time. Now we're going to talk about cash. So we're going to want to allocate, let's say, 10% to your cash reserve. Keep this in a high yield saving account or in short-term treasury bonds. This is your opportunity fund and your safety net. If markets crash or a golden investment opportunity appears, you'll have cash ready to deploy. But also, you need cash for living. So stick with the 4% rule, which is that you can live off 4% of your net worth annually. So even if you're growing your wealth at an average stock market return of 8%, your wealth will always be growing because your return is higher than the 4% that you're taking out every year. And then finally, the last investment bucket we're going to talk about is your growth portfolio or your capital appreciation strategy. The intention of your growth portfolio is to capitalize on the best opportunities. The bulk of your returns will come from here. However, the thing is with this part of your portfolio is that you may need experience or the help of a talented investment manager to identify the correct opportunities at the correct time. Otherwise, you can easily lose money. So overall, I would recommend 5% allocation if you are doing this yourself, and you can scale that up to 20% if you're working with a talented investment manager or you know what you're doing. Investments in this bucket are highly dependent on market cycles, how much money is floating around in the global economy, etc., etc. So I cannot give you examples of what to invest in right now, since if you're watching this video in a year from now, it won't be so relevant. However, for the purpose of examples, previous high growth opportunities that I found and recommended to family, friends, and now Seneca private clients was renewable energy, for example, in 2020, which returned approximately 300% in 1 year. Bitcoin in March of 2020, which is now up approximately 900% or so. And then a basket of tech stocks, which I recommended in March of 2023, which are all up now by varying degrees, but on average about 100%. So if you'd like to leverage my expertise and gain exclusive access to your own private wealth desk, check out senecaprivate.com/apply, or you can click the link in the description. Okay, so now here are some key investment principles to keep aware of when you have a net worth of $10 million. Firstly, prioritize capital preservation. Don't gamble your $10 million on a single venture. Even if you are a young entrepreneur comfortable with risk, if your goal is wealth preservation and keeping your money for the long term, you should set a portion of your wealth as an untouchable nest egg, invested conservatively to ensure you never fall below a certain net worth. Your riskier bets, like new startups or speculative investments, should be made with just a small portion of your wealth, not the whole pie. Secondly, diversify across and within asset classes. It's not just stocks versus bonds versus real estate. Diversify within those categories too. Own a mix of industries within your stock portfolio, different types or locations of properties in your real estate portfolio, and then for bonds, various issuers and durations. This way, no single economic event can take you down. If tech stocks tank, your other holdings, let's say bonds or real estate, help cushion the blow. Now, thirdly, don't ignore alternative assets. With $10 million, you have access to investments that others don't have, so take advantage of that. You might allocate a portion to hedge funds, private equity, or venture capital, which often require high minimums that you can now afford. Or you can make it fun. Look into lifestyle assets such as art or classic cars. Fine whiskey, which wealthy collectors often invest in. These can double as enjoyment and investment. For example, I have a small allocation in whiskey casks, but I often get to go on distillery tours and network with other investors and meet like-minded people. So you get a lot more than just the investment returns of whiskey. And a little interesting fact on investing in whiskey casks is that it doesn't incur capital gains tax by the Irish or UK tax authorities if you invest in the whiskey from these regions. Now, fourth, manage risk proactively. With great wealth comes great responsibility and exposure, so make sure to protect your downside. Ensure that you have proper insurance. For example, property insurance for your real estate, maybe key person insurance if you have significant business interests, and consider holding assets like boats or rental properties in an LLC or limited liability company to limit the risks of lawsuits, for example. What I'm trying to say here is you're trying to disaster-proof your life. One lawsuit or accident shouldn't threaten your 10 million. Now, the final point here on the investment side is to stay liquid and stay agile. Avoid tying up all your money in long-term assets because opportunities will come knocking. Maybe a chance to buy a company, invest in a venture, or there's just a stock market crash sale. Keeping some portion in stable or liquid assets means that you can seize opportunities quickly when they appear. Also, avoid over-leveraging. Debt can be a very useful tool, for example, mortgages on properties, but ensure that you can always cover loans even if the economy has a rough patch. Now, investing is only one part of the equation. You also need to guard that wealth from something that can almost be as damaging as bad investments: taxes. So in the next section, let's uncover how the wealthy legally minimize their taxes and even use international strategies to their advantage. So if you're earning a high income, let's say greater than $500,000 a year, or you're sitting on 8 figures, taxes can easily become one of your biggest expenses. A solid tax strategy can save you millions over your lifetime. So let's break down how to keep the tax authorities from taking more than their fair share and legally. So first, you want to optimize your tax efficiency within your investments. Structure your portfolio with taxes in mind. For example, in some countries, like the US, profits from investments that are held longer than 1 year are taxed at a lower rate than short-term gains or assets that were sold within 1 year. So avoid unnecessary buying and selling that triggers these short-term tax rates. You could also consider tax-efficient investments. For instance, municipal bonds, if you're in the US, pay tax-free interest, which can be great for high earners. Or, as I said earlier, whiskey casks are capital gains tax exempt also. Then there's also tax loss harvesting, whereby selling losing investments each year can offset gains and reduce your tax liability. Now, second, we can try leverage where you live. High net worth individuals often choose their state or country of residence based on tax impact. If you're in a high tax state or country, simply by moving could give you a huge raise by cutting taxes. For example, in the US, living in Florida, Texas, or Nevada means zero state income tax. versus California or New York, where state tax can exceed 10%. So if you're generating an annual income of above $1 million every year, that difference alone is $100,000 every year. Now, you can also think internationally. Some countries have extremely favorable tax regimes. Dubai, or the UAE, is a very famous one. It has no personal income tax and is very welcoming to wealthy expats. Also, there are many Caribbean islands with the exact same. Perhaps that might suit you better. Personally, my residence is based in Paraguay. It's an amazing place with a very favourable tax regime where I can spend a few months in the year living there and then spend the rest of the year travelling, all while securing a 0% tax rate. Now, another benefit of this approach is not only can you lower your taxes, but you can even obtain a second citizenship by becoming a resident in some of these tax havens. Now, before I continue, just to give you a few more examples of tax havens that might be worth looking into, there's Monaco, which has no income tax on its residents. There's also Singapore and Hong Kong that have low taxes and also are great business environments. Now, if you're American, you have a unique challenge. The US taxes citizens on their worldwide income, even if you leave the country. So some Americans move to Puerto Rico as a workaround. Puerto Rico offers special programs where qualifying residents pay only 4% on business income and 0% capital gains tax. Imagine zero tax on your investment profits. Now, that's a big incentive. Now, what's important to note is most of these places have their own unique special rules. For example, Puerto Rico requires you to live there for most of the year and make it your tax home. So always follow the law. These laws only work if you legitimately change your residence. If you're considering an international move or change in residency, I'd recommend consulting with a tax attorney about exit taxes or other implications. For example, Americans that renounce their citizenship may face an exit tax if their wealth is above $2 million, which with $10 million, you probably might have to face that. Plan ahead with experts so that a bold move to save on taxes doesn't trigger unintended costs. Now, thirdly, use legal entities and structures to your advantage. The wealthy often don't hold certain assets in their personal name as much as you might think. They use limited liability companies and trusts to optimize taxes and protect their assets. For example, if you have investment properties, owning them through an LLC, as we spoke about earlier, can not only shield you from liability, but also give you some tax flexibility, such as being able to write off expenses and separating them from personal finances. Trusts are another powerful tool. A property structured trust can remove assets from your taxable estate, safeguard them from creditors, and set rules for how your heirs access the money. So if you plan to pass on your wealth, look into irrevocable trusts or dynasty trusts that can extend for generations. And if you have charitable intentions, consider a charitable remainder trust or a donor advised fund. You can get a big tax deduction sometimes for donating assets, while the funds can be distributed out to charities over time. And the investments in the meantime continue to grow tax-free. So the bottom line here is essentially that structuring your $10 million can plug many leaks where taxes might seep out. And now the fourth point on this is that we want to squeeze every available tax break. High-income entrepreneurs often have unique opportunities. So if you have a business, make sure you're taking advantage of business deductions from things like home office expenses to research and development tax credits, if applicable. Depreciation on certain aspects of real estate or even things like aircraft or heavy equipment, if used in business, can give huge paper losses to offset income tax. Now, another tip that we kind of touched on earlier is charitable giving. Rather than simply cutting a check to, well, in the US, the IRS, donate to causes that you care about and get a deduction for it. With $10 million, you might allocate a portion each year to charity. It does good and saves you taxes. In fact, philanthropic tax planning is very common among the wealthy. So again, use a donor-advised fund to bunch donations and maximize the tax impact in high-income years. Alright, so we've touched now on making money and keeping money. Now it's for the part that many people dream of, which is spending money. But as you'll see, even here regarding spending requires strategy. So in this next section, we'll discuss lifestyle, how to enjoy your millionaire status responsibly, and ensure that your wealth lasts. This is where many new wealthy mess up, but that won't be you. So let's talk about living the good life without sabotaging your future. So you've got your investments generating you a return, your tax strategy is optimizing what you keep, and now comes the fun part, living life as a multimillionaire. But here's the thing, lifestyle can make or break you. I've seen many stories of people go from 10 million to zero by tipping just on the wrong side of how they approach their lifestyle. So firstly, we need to avoid the trap of lifestyle creep. It's tempting to upgrade everything. Luxury cars, mansion, expensive toys, and 5-star travel all the time. Enjoy your success, but let me explain how to keep your spending in check so that you can spend but still grow your wealth every year. A good rule of thumb is to live on the income that your assets produce rather than the assets themselves. For example, if your 10 million is invested and earns, let's say, 3% annually, that's $300,000 from just the interest payments and the dividends that you receive. So then you would want to spend that $300,000, but don't sell the actual assets, which should be in the long run appreciating in value, and so you can continue to benefit from the capital gains and the increase in your wealth, all while just spending the income that you make from these assets. Living on this $300,000 a year will keep your principal intact so that you can maintain that lifestyle indefinitely. Alternatively to that income rule I just mentioned, where you just live off the income that you receive, you can just set yourself a withdrawal rate of, let's say, between 2 and 4% every year of your net worth. As long as your assets are correctly invested, you should be earning in excess of that withdrawal rate on average every year, therefore getting to spend an adequate amount while also preserving and growing your wealth. This approach guarantees freedom forever. So now you also want to be strategic with your purchases. Let's talk about your primary home. Buying a beautiful home is often a priority for a high net worth individual. A common guideline is to keep your primary residence around 20% of your net worth or less. So for having a net worth of $10 million, that means buying a home of around $2 million. That way, you're not tying too much income up in a non-income producing asset. And you also need to factor in maintenance costs, property taxes, insurance, possibly staff. Larger homes have larger ongoing costs. Now, perhaps you also want a ski chalet or a beach villa. That's fine, but ideally you want to rent that out for most of the year and choose a good location for increased investment potential. Some high net worth individuals typically will just rent luxury places while vacationing, so then there's no long-term strings attached. So if you do buy, again, just keep the costs relative to your net worth, be mindful of the upkeep costs, and ideally focus on keeping it as a good investment where it provides you an income and increases in capital value. Now let's talk about cars, boats and planes. These are classic money pits if you're not careful. So a good rule to have here is don't spend more than 5 to 10% on depreciating assets. Yes, you have the funds to buy the higher end cars, but don't go building a 10-car supercar collection unless you're truly passionate about supercars and that you can live with the fact that you're going to have less to produce an income and increase your wealth over time. Yachts and private jets are even more expensive again to not just purchase but also to maintain. For this level of wealth, it's still smarter to charter or join a fractional ownership program than to outright own any of these assets. Then there's also art, jewellery and collectibles. These can sometimes be considered alternative investments, so if you love art or watches, you can allocate a small portion of your wealth to collectibles like these that tend to hold value, for example high-end art or vintage wines. But just do it for the love first and the investment second. There are things like carrying costs, such as storage and insurance, and it's not always easy to actually sell these investments. Oftentimes you might need to find an auction house to sell these assets, and there's no guarantee of the money that you're going to actually get back. So keep such lifestyle assets to a minimum, so let's say maybe 5% of your total net worth, or less. Finally, think long term. I mean generationally. You've built, or suddenly acquired, this $10 million. How do you ensure that you enjoy it and that it benefits your family and your causes for years to come? Remember that 70% of wealthy families lose their wealth by the second generation and 90% by the third. The culprit is often a lack of planning and communication. So to avoid this fate, involve your family in your wealth plans. Your children should be educated about money early. Consider setting up structures such as a trust fund with stipulations. So for example, your children will only get X amount at certain ages, or if they meet certain conditions such as graduating from college. These are good ways to instill responsibility. You might create a family mission for your wealth. For example, the quietly wealthy Wallenberg family have a motto, esse non videri, which is Latin for to be, not to seem. The family uses this motto to guide their approach to business and wealth. They rarely give interviews, they're rarely seen, and I could take a guess that you've probably never heard of them. So you may not actually think of anything when you hear the name Wallenberg, but they are one of the most successful dynasties on the planet and have successfully lived by their motto for generations. Also, plan your estate. This means having a will. You might hire an estate planner, or if your wealth starts to go beyond $20 or $30 million, you might set up a family office infrastructure. The earlier you do this, the more options and possibly less cost you'll have. It's much better to be the one deciding where your money goes rather than the courts or the government. And so finally, on the lifestyle front, remember why you wanted wealth in the first place. Likely it was for freedom, so freedom to do what you want, with whom you want, or to make an impact. So invest in experiences and personal growth. Travel the world. Pursue hobbies or passions that you never had the time for before. Spend quality time with family and friends. Maybe fund an annual trip or a family reunion. For example, a friend of mine who is an heiress to a wealthy European family told me that her family hosts a massive annual party in a different European city every year. What a brilliant way to spend your money. Something meaningful that brings joy to the people that matter the most. Many wealthy individuals find that beyond a certain point, more stuff doesn't make them happier, but meaningful experiences and relationships do. So use your wealth to enrich your life and not just your possessions. So, to summarize the most important points here, live off the income, not the principal. Set a reasonable annual spending limit, so somewhere between 2 and 4% of your total net worth. Secondly, only buy assets that hold value. Whenever possible, direct your big spending towards things that at least retain value. So things like real estate or quality art or equity in businesses, rather than just pure expenses. Thirdly, you want to protect your downside. So ensure the big things: health, life, liability, property, etc. And finally, plan your legacy. Get your estate in order and communicate with your family. This ensures that your wealth continues to serve its purpose beyond your lifetime. So you should now have a reasonable roadmap for making the most of your $10 million. The difference between those who stay wealthy and those who fall back down is execution of these principles that I've discussed. If you'd like to leverage my expertise and knowledge specifically on protecting and growing your wealth, and to get exclusive access to your own private wealth desk, visit senecaprivate.com/apply or click the link in the description. And I look forward to seeing you in the next video.